The Japanese yen is under pressure, and it's all eyes on the Bank of Japan, BoJ, as traders brace for a potentially game-changing meeting. But here's the kicker. Will the BoJ's decisions further weaken the yen, or is a surprise twist in store? The yen's recent slide against a resurgent US dollar, USD, has been nothing short of dramatic, extending its post-FOMC decline as the USD rebounds across the board. This downward spiral gained momentum during Thursday's Asian session, with the yen retreating from its highest level since July 7th. And this is the part most people miss. The yen's struggles aren't just about the USD's strength. They're also tied to Japan's own economic woes. Weaker than expected core machinery orders data and domestic political uncertainty have cast a shadow over the currency, giving the BoJ more reasons to delay interest rate hikes. Meanwhile, the underlying bullish sentiment in the market seems to be chipping away at the yen's safe haven appeal. But here's where it gets controversial. While the U.S. Federal Reserve's dovish outlook, signaling 2 more rate cuts by year-end, contrasts sharply with the BoJ's expected policy normalization. Some argue that this divergence might not spell deeper losses for the yen. The narrowing U.S.-Japan rate differential could, in theory, limit the yen's decline and cap the USD-JPY pair's upward momentum. Is this a contrarian view, or a realistic possibility? As traders adopt a wait-and-see approach ahead of the BoJ's 2-day meeting starting Thursday, the focus shifts to what the central bank will unveil. Will they stick to their guns and maintain the status quo, or will there be a surprise shift in policy? In the meantime, second-tier U.S. data releases could provide some short-term trading opportunities. Japanese yen bulls seem content to sit on the sidelines, awaiting a firmer USD and clearer signals from the BoJ. Thursday's government data release didn't help their case, with core machinery orders plunging 4.6% month-over-month in July, well below market expectations. This weighed on the yen during the Asian session, but is it enough to trigger a sustained sell-off? The Fed's recent rate cut, the first since December 2024, and its projection of 2 more cuts in 2025, initially sent the USD tumbling. However, Fed Chair Jerome Powell's warning about upside risks to inflation sparked an aggressive short-covering move, propelling the USD-JPY pair over 150 pips from its lows. But is this recovery sustainable, or just a temporary blip? Despite the yen's recent struggles, a significant depreciation seems unlikely given the growing belief that the BoJ will hike rates this year. The recent U.S.-Japan trade deal has alleviated some domestic growth concerns, and the BoJ views this as a step toward achieving its 2% inflation target. Moreover, a tight labor market and optimistic economic outlook keep the door open for an imminent rate hike. But what if the BoJ surprises everyone and maintains its accommodative stance? Geopolitical risks, from the escalating Russia-Ukraine war to Middle East conflicts, could also deter traders from aggressively betting against the safe haven yen. As the market focus shifts to the BoJ's meeting, with a decision expected on Friday, investors will be scrutinizing every word for clues about the future policy outlook. This, in turn, will be crucial in shaping the yen's near-term price dynamics. In the short term, traders will be eyeing Thursday's U.S. macro data, including weekly initial jobless claims and the Philly Fed Manufacturing Index, for potential trading opportunities. Meanwhile, the USD-JPY pair faces a critical test at the 147.40 to 147.50 barrier. A sustained break above this level could pave the way for further gains, but failure to do so might leave the pair vulnerable to a pullback. Here's a thought-provoking question for our readers. With the BoJ's meeting looming and the yen's fate hanging in the balance, do you think the central bank will prioritize supporting the currency or focus on domestic economic concerns? Will the yen's safe haven status be enough to shield it from further declines? Or is a more significant depreciation on the horizon? Share your thoughts and join the discussion. We want to hear from you.